Hello. Good morning, friends. Sound check. 1 2 1 2. Hello. Today is Thursday, December 7th, 2023. It's your boy, TXMC. Let's do this intro. Here. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. Let's do this, baby. Good to see everyone in the chat. A few of you guys were here really early. That's amazing. So glad to see everyone. I appreciate the support. Make sure you hit that like button. We're in the early going here. As we said, it is December 7th, 2023. Today is 82 years since the attack on Pearl Harbor that brought the U.S. into World War II. For a little dip back into history, let's listen for a second.
Mr. Vice President, Mr. Speaker, members of the Senate, of the House of Representatives, yesterday, December 7th, 1941, a date which will live in infamy.
That was the moment that the U.S. entered World War II, altered the trajectory of modern history, and really kind of established American hegemony in the wake of the war. It's a big day in history, December 7th. I had an uncle, a great uncle, who was at Pearl Harbor when it got attacked. He was not killed. He survived. I heard the stories about it when I was a child, and I don't know, just thought it was cool to mention that important day in history. So anyway, let's get this started. We'll look at Bitcoin and crypto and all those beautiful things. We'll also touch a little bit on the recession stuff. And, if we're lucky, we'll keep this stream to about an hour today. See a lot of my friends in the chat that I recognize. See Blockchain Lurker, Obaid Ali, Oscar Hernandez, what's up? JB Estrada, what's going on? See a few of you guys in there. So where were we? Last time we spoke, it was Saturday, right? And Bitcoin was here. Bitcoin was around 39, 40,000. We've popped since then, right? We had a nice weekend pump, and then a couple of days early this week, we had to move up higher, and we're now up in the middle 40s. And if we zoom out on this and we look at what was the majority of the bear market, which was really the high from 2022 and downwards, we've recovered most of that distance. We're actually up, up into the, we've recovered about 82, 83% of it here. And it looks really strong. I expect now that eventually we will come up here and we'll be threatening these highs. No matter what I think about recession likelihood or any of that kind of stuff, those things are all probability outcomes, and if they happen, then we will expect certain events to take place in the markets, things to sell off in the way that they traditionally do in a recession. But what I think gets a lot of people confused about my perspective is thinking that because I think a recession is so likely, that I somehow don't think prices can go up in the meantime, and those things just aren't true. Right, those are two completely separate ideas. And so in the meantime, for now, why fight the trend? You're just going to get rinsed over and over again when you've got this kind of a parabolic move. I mean, look at this. This is 1, 2, 3, 4, 5, 6, 7, 8 consecutive weekly candles that are green. So at some point, it really doesn't matter what you think about the economy. Doesn't matter what the probability odds of a downturn are or anything like that. Price is going up. So enjoy it while it lasts, right? Ride your spot bags. That's what I'm doing. Just because I have a broadly bearish tilt on the economy doesn't mean that I'm shorting at every opportunity either, which is often a characterization that I'm asked and that I have to defend in some way. So the trend is higher, right? And Bitcoin's really been leading the way. And one way that I think it's reasonable to kind of assess where BTC is relative to other coins in crypto is to see how much of this exact move right here has been recovered by other coins. Because if you think back to last year, this high in late March 2022 of last year, that was about a month before Luna, the wheels really started coming off. And it was like the second week of May, somewhere around in here, where everything just really ate shit, right? And so there are a lot of coins that have a fall that begins around this period of time and to have a local peak around this period of time. It's similar with Ethereum, right? And what I've been doing is looking at coins relative to this move. And so if you draw this out, BTC, like we said, it's recovered about 85% of it. But Ethereum, for its part, it's still got some work to do, right? Let me do the exact same set of lines that I do on Bitcoin. All this is just two Fibonacci retracements. One of them puts up lines that are quarters and the other one puts up lines that are eighths. And I just put them on here and they establish ranges for me. This is what I use to trade with whenever I am marking out high time frame ranges, or even, sometimes on the lower time frames, if they're well defined, I use these tools here. But we can see, like, relative to BTC, relative to the work that it's put in to recover this fall, Ethereum is still lagging far behind. And based on where we are, I think, like, just looking forward in the near term, if you're someone who's trying to play the altcoin market or just trying to play these moves in a more active way, you're not just passively sitting and watching, but you're actually trying to make rotations and profit from the moves. I think Ethereum is a much more obvious trade now than Bitcoin, just based on this look alone, right? If you assume that there's going to be some element of catching up, then BTC's got a lot of work to do, especially when you look at the ETH BTC chart, right? It's down here at the 2-year lows. We thought it was recovering a couple of weeks ago when it bounced up, but it has come all the way back. Just yesterday, it was down here at the lows. See that? It swept the local lows. Maybe it begins to recover. Maybe this is what we needed. I haven't been watching this chart that closely because I don't use it to trade or anything like that. But we can see here, look at that. We got a sweep of the recent lows on ETH BTC, and now it's moving back up, and it's trying to potentially reclaim this range here, these gray lines that had established the range for most of 2021 and 2022. So I think that because of its underperformance to Bitcoin and the fact that it's been kind of hanging back relative to BTC, it seems like the obvious trade moving forward at this stage of the rally, right? If you're just looking at the two majors together. And this morning it broke out. Finally, we got ETH popping up above its local highs. It's up around 2350 or so. Bitcoin has not followed. And after we got this pop on ETH, several of the other L2s and things related to it are also starting to move. I mean, here's optimism, right? Finally breaking up over the highs that had been established back here in August, finally ripping out of those. So we're seeing a little more life in parts of the crypto market that hadn't shown the same kind of pop. Like if you just look at the optimism chart here, for most of this rally, it's been creeping up and creeping up. And then we finally got a big candle right after all of this chop. There's a lot of the other coins that look like this. They don't all look the way that, for example, like Celestia coin looks or whatever, that have just been going straight up. TRB that just went straight up, even to some degree Solana that just went straight up. Some of these others have been lagging behind. So maybe we're seeing a rotation. And maybe over the next few weeks, we start to see some of these catch up. Now, the exercise we were just doing with Ethereum over here, it doesn't look the same on Solana. It looks like Solana has even more work to do, even though Solana's been one of the stronger performers of this rally. But just relative to this same area, it looks like Solana's got a lot more work ahead of it to catch up to where BTC is, if it's going to do that. Again, major if. I'm not calling for it. I don't even have any Solana, so this is not a position that I have like a bias on. I do have Bitcoin. I do have Ethereum. So just kind of watching this rally. I've got a few spot bags that I picked up down here in October and early November that I'm riding, and I will ride them up hopefully above the 50% retracement for most of them relative to the move from Luna. So we'll keep an eye on that. I also don't have any Link, which was one of the early leaders. So I'm out of the race on Link and Solana. I might try to pick it up for a swing trade if it comes down below maybe $10, maybe below $12, below this halfway point. If it gets down here, I might do that. But it's not high on my list of priorities. So we'll see what happens when it gets there. But just trying to give you guys some full transparency into my holdings and what I'm looking at. Looking over at equities, they've had a pretty ho-hum week. Equities are just cooling off after this massive move that took most of the month of November, and we're just kind of waiting to see what happens, right? If you look at the S&P, it's at this resistance right here. It's there. Same thing with the NASDAQ. We're right there. Same thing with the Dow Jones. Well, the Dow Jones is a little bit higher, right? But it's trying to find out, is this now support, this former resistance? Are we going to continue higher? We'll see what happens with equities. The structure, market structure, still looks pretty good. This is a weekly chart. It still looks healthy. It doesn't look like it's ready to completely roll over. I mentioned, was it on Saturday? I think I mentioned on Saturday that one thing I would be potentially interested in as far as a short trade goes on like NDQ would be if this closed as a swing failure. And we haven't really seen that. You see, the high hasn't really been put in the way that I would want it to. So where's my drawing tool? When we were talking on Saturday, I drew something like this. I drew a candle body like that, like that. And my thought was, if we get, and assume it's all red. My thought was, if we get a sweep of these highs and then it closes back down below these levels here, that is a quality, weekly chart swing failure, and that I would trade it back down into this level here. But we're not forming that candle, so I'm not looking for that trade right now. I'm just patiently observing. I'm not in a hurry to get in here. And to be honest, I think that when you have such a clear and powerful uptrend, you shouldn't be too eager to jump into counter trend trades. If they have a really clear setup, or if you have really short targets, like if you're just doing an intraday trade, that's one thing. But if you're trying to take like a multi-day trade that is counter trend, you need a really clean entry trigger and a clean setup to encourage that. And I don't really have that. So I'm not looking to short. I may have concerns that the market will roll over at some point and that a recession is still likely. All of that is still valid, but only a moron would just blindly start shorting the whole market here and just close their eyes and hope for the best. That's not the way that a rational person operates. So I will wait for triggers. If I don't get one, I'm in between a couple of key levels, so it's fine. I'll just wait for it to go up here and sweep these highs. We'll see what happens. DXY, been watching this one because the main question has been whether or not we would go down and retest the lows, or if this middle area would be a reversal point. And you see all these lines. These are all like key levels that I have marked here. Some of them are key SR that go way back, like these yellow lines are key SR levels from years ago. Right, this marked a high, wick high, and a close high from 1989. These are areas where price has reacted. You see this acted as support on the deviation. We got below it, sell off. Same thing over here. It broke above it pretty sharply. It stopped at the next level. And then the sell off, the rollover of DXY came back down to this level. And if you just go back in time, you can find a lot of instances of price interacting at these key junctures. And so I marked those out as just kind of key SR. And a lot of those levels mixed with the yearly open, some quarterly opens, they're all clustered right in this middle zone here. And that's exactly where the DXY bounced out of, the dollar bounced out of, and it's now coming back to back test it. So I'll be watching this. I think that it's not, I wouldn't expect this to have a major impact on what equities or Bitcoin are doing unless the dollar gets above this area here. Because really, when you think about what DXY does, like the dollar, yes, the dollar is correlated to other things, but when it has the most impact is when it's trending, not when it's stuck in a range. This is the same thing that we've looked at with real rates. Like if you guys recall, we've looked before at the behavior of the S&P 500 and like the 10-year real yield. And those things are interesting to look at because if you look at real rates, let me put this on a chart for you guys. Let's put the S&P up here. Zoom in. If you put the S&P up here, when real rates really started lifting, this is inflation adjusted yields, the 10-year, the real 10-year rates. When real rates really started rising above their multi-year trough, that's when equities started to sell off. And when real rates reached a local peak, which was in October of last year, and then they went sideways for almost 9 months, this period here, that was when equities troughed and they began to rise. And when they really rolled over was around this period of time right here when real rates broke higher once more, right? And then equities found it hard to continue their trend and they entered a bit more chop. And when the actual breakout came, it was a sell-off in equities. It was a hard sell-off. And we went over some of these dynamics a couple streams ago. It related to the announcement from Janet Yellen about the amount of duration that they were going to be releasing into the market. It was the Fed pause. There were a lot of forces kind of happening around in here. But the breakout of real rates, the consolidation of real rates, and then the breakout again mirror the fall in equities, the buildup of equities, and the fall again in equities. The same kind of thing happens with the dollar, right? So when the dollar really breaks out of a range and begins to trend either up or down in a steady way, it can have the correlations to other markets tend to rise. But once you get into a period where it's kind of cooled off and we're just kind of range bound, like in here, then, it can go up, it can go down, it can go up, it can go down. And the correlations tend to soften, right? The correlation to other markets, they tend to soften and you can have more idiosyncratic movements. But then once in a while, you get another sharp move like this and people start to pay attention. So I think what we're looking at with DXY, because we have this big range right here, the real question is, maybe it starts to climb and it can do this without really disrupting equities a whole lot. But if it gets above this level, if it gets above this area and actually starts to trend higher, then I think that would be a moment right there when people would start paying a lot more attention. And we might see correlations rise again and risk would struggle in this period of time here. That's what I think would be most likely to happen if the dollar gets back up there. But that's a big if. What else was I looking at right before the stream? Oh, yeah. Sorry, I don't really have an agenda here. I just kind of look around at the charts and I have a bunch of ideas in my head. And then when the stream starts, I just kind of hope that I remember it all. So we're just going to kind of free flow and run through these. I've been looking at the high time frames just to kind of get a sense of where I think Bitcoin year to date is. And, I look at other assets like this way too, but I think it's really valuable once in a while just to pull up a 12-month chart and a 3-month chart and give it a look. They seem kind of like a meme because no one ever looks at these charts, but they're really valuable. They're valuable for assessing whether or not you're at the extremes of a range or whether you think there's more potential ahead for whatever trend is currently in place. When you look at BTC here, it has recovered almost the entirety of last year's candle. If we actually make this a range, like a fib range, we're well above the 786 from last year's fall. And we've recovered the majority of it. I would say that this is at the extremes of this range. If we go down to a quarterly, this is where it gets a little interesting. So this is your 3-month candles, right? And obviously this was the bull market. Here's the retrace. This is the massive sell-off that we've been using as our proxy for how well different coins are doing in their recovery. This is that big candle right here. And as you can see, we've recovered almost the entirety of the doom candle. And interestingly, we're kind of coming up into this resistance here. You see that? You see the compression of these two bodies. Yes, there's these big wicks, but where price actually settled, where the majority of the action took place, is inside these bodies. And they have a lot of compression here at the high end of this area right here before it rolled over. And we've just come up into this zone. We're there now on a 3-month candle that has 24 days left. And this took all of the year to recover, right? This is the entirety of 2023, these 4 candles right here. And so the question I'm asking myself is, just with this perspective alone, okay, like it's difficult to do this, but put away the narratives. Put away, oh, we've got an ETF coming. Put away, oh, why would anyone sell? Like, just put that stuff away and just look at the chart and ask yourself, after this massive move higher this year and us coming up into resistance, after a big local rally as well, that's taken, the last 2 months. If you look at monthly candles, look at that, right? This was the move that took us up into that resistance. 3 really strong monthly candles. So what I'm asking myself is, have we put the high in for the year? Not for the whole rally, not for the entire retrace move. I don't know the answer to that. But just this candle, this 3-month candle that ends at the end of December, today's December 7th, it's pushed all the way up into quarterly resistance from the bull market. So I'm wondering, and it's a question that I think everyone should ask themselves, have we put the high in for the year, or are we very close to putting the high in for the year, for the rest of December? I think it's a reasonable question. I think there is a fair distribution of possibilities there that it is yes or no. I think it's at least a coin flip that we've put in the high for December, and then maybe we spend a couple of weeks cooling off here. I don't know if that's true, but if we look at asset returns, let me close this. If we look at returns let me make this a line chart. Make this white, and let's look this on like a 5-day basis. There we go. And we'll make this nice and thick so you can see it. Like that. There we go. This is 5-day returns. 5-day rates of change. Now, one thing you'll notice, it's the main thing to notice, is we're right here, right? We've put in a double-digit move on a 5-day basis. And there's a few other times this year that we've done this. You see that? All of these marked temporary peaks. I shared this the other day. A bunch of people lost their minds and thought I was calling for the top of the rally. Like, emotions are so crazy right now. It discourages me from wanting to share any of my opinions on Twitter because people are just such idiot mouth breathers about the market right now. We are definitely in the early stages of euphoria. I think it's undeniable. But I shared this on Twitter because I think it's an interesting observation that in 2023, anytime we have had a double-digit percentage move on a 5-day basis, it has marked a temporary high for at least a few days. Now, every high in 2023 has been temporary because we're at the highs. So take this with a grain of salt. But if we're going to think about this rationally, we have this pattern here of 5-day returns at double digits, marking local peaks, right? And then, oops. Okay. And then if we go back over here and we draw some key resistances, let's draw these out. We are at the 50% retracement. We just broke through it of the entire bear market. You see that? And additionally, I'm going to draw my support lines back on here, and I'm going to put my key SR back on here. And additionally, we have pushed up to this key level. See that dashed line? We tagged it on the weekly chart. We tagged it perfectly on the daily chart. You see that dashed line right there? That's one of my key levels from here. We tagged it perfectly. We've just broken key SR, which was a bull bear pivot during the prior cycle. And this happened after 8 weeks of straight up into quarterly resistance. So I'm just saying it's a reasonable question to ask if we have put the top in for 2023. I don't know. I'd like it to not be true because I'd like the price to just keep going higher and make my spot bags worth more and more money. And the long trade that I am still in from 31 or whatever price it was, 33. So yeah, I'd like it to go higher, but just there's kind of a confluence of factors that suggest we may be running out of steam temporarily, and it may take us some time to cool off. And that's fine, because during that period of time, something like Ethereum and its related coins, maybe they can play a little bit of catch up. It's got some work to do. Bitcoin's all the way up here. That would be equivalent of 3,200 Ethereum. So we'll keep an eye on it, right? Let me take a pause, take a sip of my water. Now, whenever I show these price charts, inevitably someone in my comments tells me that they don't like my TA and that it's too basic and that I should just stick to talking about the economy. But too bad. You guys are going to see it anyway. Let me take a moment here and look back through the chat and make sure I haven't missed anything, and then we'll keep going. If you haven't hit the like button, please make sure to do that. And if you haven't subscribed to my channel, do that as well. Hit the bell icon. Make sure that you are alerted next time I go live. That is the best way for you to support the channel. Thank you so much. Wow, got a busy chat today. You guys are really talking it up. Can I check global liquidity? So I don't really look at liquidity metrics. I think they're a little bit of a meme. They don't explain everything, but people use them to explain all market movements. I look at liquidity sometimes. I don't have a chart readily available to pull up. I might see if I can build one for like the next stream or something, if I can find a good one. But I don't really find liquidity charts to be that useful. I would much rather look at the price chart and measure other aspects of the economy and their rates of change. I think that just assuming that this amorphous word liquidity just explains all things is not a very rational take. And I see a lot of things that I just don't agree with online when people refer to liquidity. So I'm just going to kind of avoid that. Okay. So that's kind of where we are in the market. There's nothing really major to say about this price action. A lot of people think that this is the beginning of a new bull market. I don't believe that to be the case. I think that the global economy and the US economy are in a very different place right now than at the start of prior crypto bull markets. And that is something that is grossly dismissed by a lot of people who are calling for the next cycle to begin. I think that we are actually at the tail end of a cycle rather than the beginning of a new one, and that we have not yet seen the conclusion of it. But we've got a lot of people arguing that we've already done all of the hard stuff and now it's just smooth sailing. But we still have rising delinquency rates. We still have rising bankruptcy rates. We still have slowing labor. So I don't really know what people are talking about, to be completely honest. I think it's just a lot of irrational exuberance and euphoria. And that's exactly what we thought we would see when BTC got up into its retracements, right? Any market, when it starts to get above its, doldrums, when it really starts to recover. I mean, equities are way ahead of Bitcoin in this regard, right? They're all the way up here. And that's when we start seeing people being overly exuberant, saying that this is a new paradigm and valuations don't matter, and tech drives the economy, so of course it should have a 35 PE or whatever. And those things just don't make sense to me. So I push back on them at every opportunity. And I've been looking at some of the recession data lately, and there's some interesting things. So I constructed a big table of growth rates, and I wanted to compare today's rates of change across the economy. These are all the metrics that we use when we analyze the economy. So whenever we have our tables where we look at all the different growth rates of all the different eras, and we compare today to Fed tightening, or today to the yield curve, or today to when recessions start, we use this big table of metrics. Now, it doesn't matter what these abbreviations are. That's for me to understand. But I built a big color chart here because I was trying to see, okay, where is the strength in the economy? What is outperforming versus the norm? What is underperforming versus the norm at this point in time relative to the Fed raising interest rates? Because that's really the response function that everyone is paying attention to, right? The Fed's monetary policy. And it is one of the primary forces in any business cycle, is the Fed's own reaction function and where they are in their tightening or easing. And just a couple of things I'll point out about this. We won't spend a whole lot of time on this table. Don't really pay attention to the numbers. You can even take the numbers off of here. The thing is the heat map, right? And a couple of things jump out at me here. The first thing jumps out to me that when the Fed began tightening, the first early months of tightening were last year, right? They were March, April, May, June of 2022. And during that period of time, we had the market dropping really sharply, and we had cyclical parts of the economy like industrial production and the ISM PMI surveys, real manufacturing sales, those kinds of things all dipping really hard. Housing sales dipped really hard. And we can see that here in the cyclical section. You note how early last year, we're 20 months into Fed tightening, 21 months, and this is March of 2022. The cyclical areas in red underperforming where the market usually is early in a Fed tightening. But as we've moved forward, the cyclical parts, the more leading areas of the economy, more tied to goods production, manufacturing, and that kind of thing, those parts are starting to perform better than they normally do at this stage of Fed tightening. That's why you're starting to see blue appear here. And we've talked about this a little bit. In the prior couple of streams, we briefly touched on how certain cyclical elements look like they're curling up. Now, they're curling from relative lows, but those activities, those sectors of the economy are starting to do a little better because they spent like 18 months in the absolute shitter, and digging out of those lows starts to make them look pretty good. So we're starting to see blue appear here in the cyclical pieces of the economy. When we go back here and we look at those parts, we can see some of that growth. No, that's not it. Sorry. It's here. We can see some of that growth. So this is real retail sales, real manufacturing sales, and industrial production. And what you see about these three things relative to when the yield curve inverted is you see the black line below the gray line on each of these three sections. And that showed that the growth rate of the current cycle was below the average of all the prior cycles from when the yield curve inverted. So we had really low, really poor cyclical performance. But just recently, things like manufacturing and retail sales, they've started to accelerate a bit in rate of change terms above where they normally are at this point of the cycle. You see the black lines getting above the gray lines. That's the same thing that we're seeing over here with this blue. So that's kind of how this whole table works. Taking that forward, if we look at credit, you see how it was blue back here. In 2022, it's faint blue. In 2022, we still had credit growth. And as rates were initially rising, there were a lot of people levering up in anticipation of future higher rates. That happens a lot early in a tightening cycle. As people anticipate that borrowing costs will be higher in the near future, in the 6 to 12 to 18 months ahead of now, they begin to take out credit early. That happens across sectors. We saw that last year as the Fed began raising rates, but then it reached a kind of an equilibrium point and credit began to really slow down. And now we see all of this orange that's showing credit underperforming where we normally are at this stage of the cycle. That can be seen if we go look over here at things like business loans relative to Fed tightening. See that? Down here below all prior eras. That's being corroborated by all the orange that we're seeing on the credit heat map, the underperformance. But where it gets interesting, labor market. This is the place we've spent a lot of time paying attention, right? Because as we've identified, once you get past the point where the cyclical pieces have softened demonstrably, you're starting to see Fed policy trickle into the credit markets. Debt is beginning to slow down. Consumption has started to slow, though it's still strong. Now some of those things are feeding into labor. Early in the cycle, labor was outperforming the normal growth rate because we had really strong job growth and we had very low unemployment. But as we've moved forward, particularly in the last 8 months or so, the labor market has really started to underperform. You see more and more orange proliferating down here in things like long-term unemployment, unemployed persons, vacancy rates for jobs, temporary workers. Those things are all worse than they normally are, or at least are low performing relative to prior cycles. That's interesting to me, and that encourages me to continue paying attention to labor because job loss is the recession. So until we actually see a snap in the labor market, it's not reasonable to expect that we are in a recession, though it is pretty clear that we are very close to one in terms of rates of change. We're kind of like standing on the edge of the diving board with our toes hanging off the edge, but we haven't actually jumped yet. We haven't even begun to bounce on the board, but we're right on the edge. And it feels like, any kind of bad news, if a company suddenly laid off a bunch of people, or we had a major lender, maybe a shadow bank lender or something go under, that could kind of push us over the edge. We'll have to see. But the market performance, this is the last thing I'll say about this, then we'll look at some other charts. Market performance is really telling some of the story of what we've been seeing. And you see a lot of orange and blue mixed in here. So let's unpack these. What is actually outperforming? It's these three rows here. And what are those things? The NASDAQ, the S&P, and XLK, which is the technology sector of the S&P. Those things are strongly outperforming what normal performance for those assets looks like in the second year of Fed tightening. Normally, by this point, that performance is starting to slow down. And what's interesting is this is the bear market. This is all of 2022, right? From March of 2022 until the end of the year, we had a bear market. So the NASDAQ was underperforming in orange here. So was the S&P. So was technology. Was underperforming last year relative to when the Fed normally begins tightening. Because as we've explored, if you recall from our Recession Roundup series, which was posted in July, you can find that on the channel on YouTube. If you go to my playlists, there is a 4-part series that goes into a lot of these dynamics. The Fed normally begins tightening early in a growth cycle, and they slowly raise interest rates over a couple of years as the economy continues to grow and as assets continue to perform well. But last year, they jumped in front of a moving train. They started raising rates in a very strong market and a very strong economy, and it created an immediate repricing of all things, right? We had a massive crash in the bond market because we ended the zero interest rate policy, and that crash in the bond market repriced all long duration assets. It repriced all tech. So tech had a terrible year and it underperformed. But 2023 has been a different story, and all three of these assets are now outperforming their normal averages. But other things like energy, like the financial sector, like consumer staples, like utilities, like commodities, like the Russell 2000 and gold, things more tied to real assets and the real economy in a lot of ways, those things are all underperforming. And when you think about what the market has been this year, what the narratives are, it's all AI, it's all the NASDAQ, it's all big tech, right? We know the Russell has still been in a bear market. It's still well below its yearly highs, though it's been recovering a bit just very recently. And so I found this heat map pretty interesting to look through the different sectors to see how they're performing. This kind of tells part of the story of this cycle so far. And I think that's pretty interesting. So something else I was looking at recently, this is someone I follow on Twitter, Eric Basmajian. He does some good research. He does a lot of research around recessions, and he and I have a similar approach in the way that we look at economic data. And he did this big thread on something called the SOM rule. Now, we've talked about the SOM rule on the channel here, but we haven't always invoked its formal name. Some of you may remember that we've studied the rate of change of the unemployment rate, and that when the unemployment rate rises 0.5% above its cyclical lows, that tends to only occur in recessions. The SOM rule is that rule. The SOM rule states that when the 3-month average of unemployment rises above the 12-month rate, then that triggers the rule and a recession has begun. And what I found interesting about his thread, he goes through a lot of data points. We're not going to go through all this. But right here, this table, he's showing what the SAM rule measures the rate of change of unemployment, where it is when recessions start, where it is when the rule actually gets triggered, and what the difference in the time is. So how late or early in an official recession does this rule trigger and tell us that we're in a recession? On average, it's 2 months. You see that? It's usually about 1 to 3 months difference, but on average, it's 2 months. Now that is interesting confluence, because when we look at the rate of change of job growth, which is not the unemployment rate, they are related. They're not the same thing. They are closely tied to one another. When job growth falls off, the unemployment rate rises, but they're not exactly one-to-one metrics. But still, he says about 2 months into an official recession, that's when this trigger usually hits and confirms it. Well, if you look at the rate of change of job growth on an average and median basis, which is a way that we determine if there's any noise in the metrics, we look at averages and medians. The rate of change of job growth heading into a recession, which is this vertical line, the 0 is the beginning of the recession. It tends to fall off about 2 months into the recession. So this is when it begins. Here's 1, 2 months. Here's job growth going negative between 2 and 3 months into the recession. And that lines up perfectly with his analysis of this SOM rule metric. So that makes me feel good about the way we've analyzed job growth, that we've been finding consistency with what other people who are looking at the data in a different way, they're finding similar, outcomes. So then I started thinking, all right, we've got a little bit of confluence here. Could we establish a better, more leading SOM rule, for lack of a better term? Could I find some combination of the different labor metrics that we use on this channel? Like where are some of the ones we look at? We've got all of these, right? You guys remember this chart? We looked at this last week. This is a bunch of the other components of labor that aren't the straight up unemployment rate, that aren't the straight up non-farm payroll number. They're smaller components like temporary workers, people who say they got fired, the actual number of people who claim unemployment, long-term unemployed, those are people who've been out of work for 15 weeks or more, and vacancy rates. These are all parts of labor that, as they begin to soften, eventually bleeds into the unemployment rate. The unemployment rate's like one of the last things to move. So I thought, well, you know what? Let's try to construct a leading labor metric using our own data. So this was my attempt to do that. This is not meant for presentation. I know this looks like spaghetti, but I want you to see my process. Okay, so yesterday and the day before, as I was doing this is how I went about it. I decided to break up all the different eras. So we have these eras, right? I've got all these eras. These eras are years that we have recessions. You see them all? There's a bunch of them. There's like 20 of them. And so I broke them up into eras, into spans of time. We've got the post-war golden age, which is from after World War II until the early 60s. I've got the inflation era, which is from like 1965 through the early 1980s. We've got the Greenspan era, which is from the late 80s into right before the Great Financial Crisis. And then we've got the QE era, which is basically 2007 to now. And I also made one for today, but we'll take today off of there for now. And what I did was I made this graph from months from recession start, and I threw a bunch of our job metrics on here. And I actually sat here and manually clicked on each of these. And I looked at them and I said, okay, which of these metrics starts to really fall off before we get to this vertical bar, before we get to the recession actually starting? And I went down the list and I looked at all these. And the interesting thing about this, oh, that's a really difficult color to see. The interesting thing about this, that's not much better. Brown. What about brown? That's better. The interesting thing about this is that most of these metrics do function in a way, less so that one, but some of these metrics do function as a leading form of labor, right? As a leading indicator of labor. For reference, this is what the normal job numbers looks like. You see this? It doesn't move as much. It's less volatile, but it stays positive until about 2 months into the recession. That's it rolling over here. And this is this chart. We just looked at this. This is the rate of change of non-farm payrolls going negative about 2 months into the recession. This is non-farm payrolls in each of the eras that we broke up. And you can see about 2, 3, 4 months into the recession is when it finally goes negative, but it's positive before that. But all these other metrics, like if you look at a bunch of these other ones, they go negative way before the recession, months ahead of time. So I thought, all right, that seems useful. But are there any of these so can I construct a metric using some of these with enough history that goes all the way back in time, as far back as my data set goes, and we can construct a leading labor metric? So I took vacancy rates. I took people who claim they are unemployed, which is the numerator of the unemployment rate, right? For the unemployment rate, you've got the unemployed over the civilian labor force, which is all people currently seeking work or who have work, the unemployed and the employed. And so this figure right here is one of our metrics, just this number. And that is what we call unemployed over here. It's one of the series that we use. So I took job vacancy rates, number of people claiming they are unemployed, and the number of people claiming they are long-term unemployed, because I have data for all of these series going back to the beginning. I wanted to use residential construction employment and temporary workers. But as you can see, these two lines don't have any history from the inflationary period. Both of these series started in like the late 80s, early 90s. So they don't give me enough history. So I constructed a metric that uses all of these. And then I constructed one that doesn't have those, and they look almost identical. So we'll just keep the three that I have long history on, and we'll make a metric with it. Now, let's look at this metric. This is our leading employment metric. This is what we just constructed using unemployed people, long-term unemployed people, and the vacancy rates. And what you can see, I know it's kind of noisy because it's got 70 years of history on it. But if you really pause and you look, and you come back to this chart, if you just take a few minutes and look at this, look at where we are today, and find any time in history when we have been here and not been in a recession. It doesn't exist. The only time we were this low was coming out of recessions, 1991, 2002. Otherwise, we have only ever seen levels anywhere close to this in downturns. This corroborates what we looked at together last week when we looked at all the different pieces broken out, and we saw that they were all lifting above their equilibrium at rates of change that only occur in recessions. And so when we combine all of those together and we have this oscillator, it confirms all those data points all at once. And it is showing a rate of change leading the economy into a recession, or it's showing a rate of change that suggests we're leading into a recession. And this is what those two things look like Let me back up. So this metric shows pre-recessionary conditions, right? This is that line, that red line. It's the same red line over here. And this blue line is the regular jobs numbers, non-farm payrolls, and the employment figure, the ones that we said are lagging, the ones that take 2 to 3 months into the recession before you actually see them corroborate or confirm that we're in a downturn. This metric leads by many months. You notice the red line from 1939 to 2010. This is all prior recessions. This metric leads the regular labor metric by about 8 months on average. This is 6 months before the recession, 6 to 7 months. It's going negative, and it's way down here by the time we start the recession. This is today. Now, it's very choppy. I understand that. However, it's been chopping around at the equilibrium, and it is now broken down below it, and it happened about 6 months ago. And we say it leads about 6 or 7 months ahead of recession. And the rate of change of job growth looks about the same as the rate of change of job growth here. And when we look at today versus 1966, job growth right here, it looks really similar, right? This is one of those charts we've been paying attention to. Today's job growth versus the 1966 soft landing. So we've got a lot of corroborating pieces of evidence here. This is our leading employment data that we just created, our leading indicator. And this down here is the regular jobs figure. This is the leading employment from 1966 today versus 1966. And you can see we're below the rate of trend of we're below the rate of growth of leading employment from 1966 and below coincident employment from 1966. So we've been watching this metric right here. This is what we've been watching together, right? Employment figures today versus 1966 and all prior recessions. We keep coming back to this because we were at the inflection point, the place in time where 1966 started to improve. But we are still trending downwards. We've gotten a couple more prints on the employment data here, and it's following the pre-recessionary line, the dark gray line. It's not following the purple line. And so when we look at the leading metric today, the leading employment data, it is also below where it was in 1966. And even if I get rid of all of the time before the yield curve inverted and we just look after the yield curve inverted, our leading employment data is way below where it was in 1966. This is the period of time where the economy began to recover. Our leading employment data is still softening. It's not looking very good. So I apologize if my explanation of this is kind of all over the place. I've been trying to figure out the best way to present this to you guys, and doing it in real time, it's a little difficult. It's a lot of data to go over. There's a lot of nuance to try to explain. So I'm doing my best here. And I think the key takeaway for me, if your eyes are glazed over and I've been jumping around between too many charts and you're like, what's the point you're trying to make about this? The point I'm trying to make about this is that we have been really closely watching the current era versus the only example that we have of the economy getting this deep into the pre-recessionary process and bouncing out of it. That only example is 1966. And about 9 to 12 months into the yield curve being inverted, their labor market began to recover, the economy began to reaccelerate, and that was the end of the soft landing. So we've been watching really closely to see what our job growth today looks like, to see if it matches that in any capacity. It doesn't have to. It doesn't have to look like it very much at all, but it's the only example that we have. And we are data driven here. We don't go off of feelings and what we think should happen. We're using data. And so being informed in that way and seeing this trend continuing to follow the regular recessionary outcome, I'm starting to think 1966 doesn't look very realistic. And you may be thinking, okay, well, maybe it'll just take us a little more time. Maybe this will just move a little further out. Maybe this just goes like this, and then it starts to recover. That's possible. It could certainly do that. But I thought, okay, well, in 1966, what did it look like? What did their job numbers look like after this? Like, we only have this far on the chart to go, right? So, is this it? Yeah, this is it. Let me take some of this off of here. Okay. This is the jobs figure that we were looking at. This is the trough. This was the inflection point that we were talking about. Let me get that 0 off there. Yeah. And then if you pay attention, 1966 was just 3 years before the recession that began in early 1970, late 1969. And if I add that era to this era, this was the job numbers, right? So we have 1966, and then this is the beginning of the 68 to 70 era that began into the recession. See the gray bars? Here's the recession. So we're right around here in our inflection point example of 1966. In today's measures, we're right around this point right here. Well, just a year and a half later, they began to roll over into a recession anyways. It wasn't the coast is clear. It was a temporary reprieve in a longer downturn. And this is what I think is the main concern if we actually do print a soft landing fractal, is that even when they pulled this off, the Fed pulled this off, they began to ease. Or they tightened, the market turned down, they began to ease in late 67. It was right around in here. Things began to recover, and then it began to roll over again. Things started to accelerate, they started to tighten again, and we actually got a recession. And we had a whole cycle in this really small period of time right here. And I think that that's worth being aware of if we go through all this analysis of comparing today to prior soft landings, is knowing that even when the coast was clear, it was only 1 year later before employment started falling again into another recession. If we look at the leading labor market, our leading metric here, oh, come on. It looks quite similar. It looks similar, except that it went negative back here, right? This is the inflection point. We're at the inflection point. The leading components of labor back here were still quite soft, even after job growth began to rise again. And it recovered a little bit, and then it rolled over here about 6 to 8 months before their recession. Once more, the leading metric, this line on the bottom, is this chart. Once again, it rolled over about 6 months before the recession. So even when they got out of the dynamics that we currently find ourselves in today, very similar dynamics in late 1966, early 1967, it was only about a year later before things began to look dicey once again. So food for thought as far as that goes. Was there something else I wanted to show you guys? Oh, no, I think that was mostly it. The main things that I've been looking at just in the last few days, because we just had a stream on Saturday. The main things that I've been watching, because we got a few data points in this week. Let's look and see what we got. Let's go to the Forex Factory. Let's look and see what our economic data was this week. So we got PMIs. The PMIs are still in like the services PMIs still in the low 50s. That's not really that exciting. Nothing to really say about the PMIs. Job openings came down, but they've been falling. This is a number people get really excited about the job openings figure, but there's a lot of questions about the accuracy of it, so I don't pay that much attention to it. We've got some big numbers coming out tomorrow, though. Tomorrow will be interesting. We've got the unemployment rate, we've got non-farm payrolls, and we have hourly earnings. All of these will update our current tables, so we'll have some new data to look at the next time we do a stream. We'll have new hourly earnings, new wage figures, and we'll have the next NFP print, which will be really interesting. I'm eager to see that. The current forecast expects it to be higher than what it was before, and maybe it will, because if you guys recall, the auto workers union has been on strike, and some of those people have recently gone back to work. So we may actually see a big jump in non-farm payrolls. And the interesting thing to see is whether or not the market gets really out ahead of its skis on that. If it gets overly excited by seeing a strong job figure, either to the up or to the downside, just remember that the return of those striking workers, which were in the thousands, may have an outsized effect if we get like a bigger than expected print on the NFP. So that's something to pay attention to for tomorrow. But in the meantime, we'll just keep watching Bitcoin here. The economy is a really slow moving beast. And so I like to check in on the data and I like to find new ways to analyze it. But on like a week to week basis, there isn't a lot changing there. And even though we see rates of change that are very concerning, we see things that suggest that a recession is highly probable. It takes months for that stuff to really manifest. And if we're thinking about this in terms of lags, and we've already established that job growth doesn't even go negative until you're already in, quote unquote, in a recession for 2 or 3 months. And so it could be one of those things where we may not see a negative job print until like April or May. But once we get another year beyond that and we look back, they may have decided that the recession began in January or something along those lines. And if that's the case, that wouldn't really be outside the realm of reason when you look at rates of change of things today, right? If you just look at the rate of change of non-farm payrolls, where it is today, it looks like we're just 2, 3 months, 4 months ahead of the recession. So that's what I have my eyes on. And I like to keep it in the back of my mind at all times, but at the same time, risk is climbing. It's been ripping. There's no reason to fight it. And I can be a bear on the economy while also being a short-term bull on Bitcoin and altcoins. And I am. I'm also still a bull on equities, even though they may roll over here, or we're going to wait and see if they form some kind of a correction after a big move like that. It wouldn't be completely unreasonable to see equities come back down to this level here before continuing higher. Maybe it does that, especially after such a sharp move here. But I'm still bullish on equities because, as we talked about, I still think it's got room to go to finish this full fib extension off the tech bubble. And that means we've got another possibly, 12 to 14% on the NASDAQ of potential before I would think it had reached its cyclical peak. So, I'm bullish on equities if they fulfill this. They may not. It may not do this. But that's a place I've been watching for, over a year and a half now. So, not the most graceful stream today. My thoughts are a little jumbled. I'm kind of all over the place. But it's important that we keep the habit going, that we continue to check in with each other, that you guys hold me accountable to being transparent with what I'm looking at. And so, that's kind of what I'm looking at today. No major takeaways from this stream. I didn't really drop any major alpha for you guys. But I just wanted you to see what I've been looking at the past week, what I'm thinking about, and kind of where I have my eye as we head into the weekend. I'm going to scroll down through the chat here and see if I missed anyone's questions and things. I have just 3 times my viewership from last week. I'm not sure what that means. We got 218 concurrent viewers. I have 156 likes. That means there are about 60 of you who have not hit the like button. So please do so while I am taking a moment here to catch up on the stream and take some sip of water. Rational Evidence says, everything depends on how much pain the Fed will allow the citizens to experience. What's the max drop on the S&P before plunge protection, in my opinion? So that's a difficult one to answer. And I think that there's a wide range of opinions on this. I will not pretend like I know better than anyone else because no one actually knows. But most people's framing of what the market is going to do in a downturn resembles this. It resembles sharp liquidity, Fed steps in, holy shit, panic, that they do whatever they did right here, and that we just go straight up again. I don't believe that's the most likely outcome. If you look at the history of Fed responses in eras where inflation has been a factor, they tend to be delayed. Additionally, when you have a really tight labor market, the Fed tends to be more muted in its desire to ease. And we have both of those things. We had inflation in this cycle. It has come down, but it has been a factor. Thus, it's something they will not want to reawaken carelessly. We also have the tightest labor market conditions we've ever had since World War II, basically. And so because of that, and because we are only 2.5 years removed from this, I don't think we're going to get the same kind of response. It doesn't mean they won't try to ease. It doesn't mean that they're just going to sit back and watch everything go to zero. That's not what I mean by that. But what I mean is that they may try to do less than they did in 2020 because of the existence of inflation in this cycle, because of the tightness of the labor markets, because of all of the excess cash currently floating around, and because how quick demand is to come back anytime they detect some easing. Because of all of that, they may try to do less to try to be more conservative, and as a result, their response could very well be inadequate. And that is the scary thing. That's the thing that has me worried about how it could look in the recession, because we just came off of the biggest stimulus effect that we've ever had, the biggest stimulus in history, and those other things I mentioned. And for us to recover from the next recession in any way that remotely resembles this, we're going to also need an additional fiscal impulse. We're going to need more fiscal. We're going to need stimmy checks, right? And we just had stimmy checks right here. We have a Congress that's arguing about government spending right now. And so I question how much appetite there will be for the political establishment to rain down stimmy checks again the next time we have a possible recession. Just things to consider, right? None of those questions have an obvious answer because we haven't been in those scenarios before. We haven't seen a recession yet. We haven't had one since COVID. We've never saw the COVID response before. So there's a lot of unknowns. But for anyone who just talks as if they know what's going to happen, they're talking out of their ass. I've spent a lot of time studying this. There are more question marks than there are statement periods. And as a result, there's just no way to really be sure. And I think it warrants some consideration that the Fed response may not be as much of a floodgate opening as people think. Where did I learn price action? Well, I learned from a lot of people over the years, just been looking at charts for years. Could Bitcoin be the flight to safety in the next cycle? I don't think so, Dragos. I haven't seen any evidence to suggest it would be a flight to safety. It's still too small of an asset. It's still too correlated to risk. And even if it were gold-like, if it had the properties of gold, and we thought that, you can say what you want about gold. A lot of Bitcoiners think gold is useless and stupid, and they could be right about those things. But it still acts as a haven, right? Well, this is what gold did in the Great Financial Crisis. It fell like 30-40%. Fell 34% before rallying. And it did bottom about 3-4 months before the market did. It bottomed in October of 2008, but it still sold off. This was and that's the thing. There are Bitcoiners who make the argument that, well, the Fed will just react to whatever happens and they'll just pump the market full of liquidity, and Bitcoin only cares about liquidity, so it's just going to go up. Let me remind you that this was the largest injection of liquidity the market had ever seen, ever, at this point in time, and the most liquid outside money, gold, still sold off. Equities. The Fed was backstopping everything, and equities still sold off. So like this idea that like just because they're going to react to a downturn, that somehow saves assets from eating shit, there is no precedent for that. There's not one. And when you've got an asset like Bitcoin that acts a lot more like big tech than it does gold most of the time. You have to have a reasonable perspective that it will probably behave that way. So I don't think it's a safe haven. I think that maybe one day it will be, because if you think about what Bitcoin is, its actual design is a very risk-off asset by nature, but it isn't there in its behavior. And that is a distinction that needs to be made. There are the properties of Bitcoin, its potential, and then there is what it currently behaves like. So its design is very risk-off, right? It is an unconfiscatable, undilutable bearer asset, right? The terminal supply is fixed. It has a finite amount. And as a result, and because you can have full custody, there's no counterparty risk, it's actually quite risk-off. Your buying power in BTC units can never be diluted. However, its current exchange rate with other currencies and other assets is highly volatile. It's still a very speculative asset. And so as a result, you can't expect it to behave in the way that its pure properties would suggest it's capable of behaving, because it isn't there yet. It isn't there in people's minds. It hasn't matured into that role. And I believe that it will require some financial crises to bring that change about. And I don't believe that change will happen early in the next financial crisis. I believe that it will require some discomfort on the part of investors to learn hard lessons, because that is how markets always teach. It's not me being a cynical person or being a sadist and wanting bad things to happen. If you read enough financial history, you come to understand that is the only way things change, is by shit going horribly wrong and people going, okay, we got to change. We got to do something different. So they try something else. A new asset fills a role, monetary policy changes, the government changes, something systemically shifts. And for that to happen, we need a shock of some kind. And I think that's what it would take. Anyone know of a trading platform that offers soft commodities like tobacco? I don't know. I wish I knew of one. Did I see Bob Elliott's tweet today regarding labor? Yeah, I saw. Bob tweets every week about the labor market. He's someone I follow quite a bit. I like Bob a lot, but he tweets these things. He tweets these things out every week about the labor market, about how it's secularly tight, about how jobless claims are still relatively low for the most part, though we had a spike in the non-adjusted numbers, but you can see they're still relatively low relative to history. But the thing is, the way Bob looks at labor and the way that I look at labor are different, right? Bob is looking at jobless claims. I'm looking at the actual number of people that are considering themselves unemployed, the actual number of people that claim themselves to be job losers, and the rate of change of those figures. So I come up with slightly different findings than Bob, and that's partly what makes this such an interesting thing to study. How can I get access to this dashboard? Rahul, my dashboards are private. I do not have them up for public consumption, because if I did that, people would just jack all of my work and produce content with it, and I would have no benefit. There's no benefit to me doing that. So I keep it to myself and I share it with you guys. Recession doesn't really matter. What matters is, do I have a job and are markets going up or down? Well, I see what you're trying to say, rational evidence, but my counter to that would be your first question is the component that makes a recession. Job loss is the recession. And so it's important to know that even when we have a downturn, many people are still employed. Most people still have jobs. If you go to the two worst periods of unemployment in U.S. history, the Great Depression and COVID, you still had 3/4 of the population that had jobs. So even when it's bad, it isn't everybody. It's a portion. Now, 20% of a workforce not having a job is a fuckload of people. That's very bad. But it's not everyone. Most people will still have jobs. But 5 or 10% of your workforce losing their jobs is a shock. It's a massive shock to the system, and it requires certain things to reprice and to mean revert. And so it does matter in that sense. Am I expecting a new all-time high within 6 months? So I think it's more realistic on equities because of where they are, because of how close they are to their peaks. If you look at the S&P, I don't know what the S&P is going to do. I think that the NASDAQ and the Dow Jones have more potential, but they're all within 5 to 10% of their highs. They're, the Dow Jones is 2% away. The S&P is 5%. The NASDAQ is 5%. So I think that those have a potential to set a new all-time high within the next 6 months. But I would remind everyone that it could be one of these. We could be right here on big tech and not know it. I don't know if it's true, but I cannot rule it out. Bitcoin did this, and everyone thought the market was still going. Everyone thought this was the beginning of a super cycle, right? It's beginning of a super cycle. None of the hodlers are selling. Oh my God, there's no retail here. Look around. Why doesn't anyone notice? We were pushing up. There was bearish divergences, bearish RSI. All the volume on chain had already washed away. Yet price continued to push up, and we made barely a second all-time high as underlying fundamentals in the market weakened. And we saw an alt rally, right? Which is a rotational move inside of crypto. And Bitcoin set an all-time high on what was essentially a retracement. So I think it's very possible, when you think about where we are right now, that we're in something similar. Because this move has been a very thin move. It's had very low participation. This is a market cap leadership move. It's led by big tech. And only right here, very recently, in the last 2 weeks, 3 weeks, have we just now started to see the Russell joining in a little bit, right? The equal weighted S&P joining in a little bit. And what are people saying in crypto right now? What are people saying? Super cycle. This is the beginning of a new super cycle. I just saw this the other day. Where was it? Let me go look at BC Backer, because I replied to him and he's the one who tweeted it. Let me go find the homie real quick. Is it here? No. Where was it? This one. Financial media luring and retail. Look at this. Bloomberg says it's the start of a fresh crypto super cycle that will push Bitcoin above 500,000. Also, people posting things like my dear friend Checkmate. This is not a knock on Checkmate. But there's a lot of these posts, right? The hodlers are not spending their coins. They demand higher prices. What's going on? We're pushing up towards the highs, but no one is spending anything. If you look back to my tweets, Wyatt TX. Oh, haha. MC Trades. Wyattist. Look at this. October 2021. In terms of age and volume, this has run up to the all-time high as the quietest in history. Usually, old coins come to life looking for exit liquidity, but the chain is quiet. This was in October of 2021 as we're pushing higher. And literally just 2 days ago, Checkmate is like, what's going on? The hodlers, they're not selling their coins. They demand higher prices. And, it's a new super cycle. We're going to go to 500,000. It's literally the same narrative that we had right here. The exact same narrative. Now, I know we just went through a bear market, but people are saying the same thing about equities. This is a new expansion, right? This is a totally new expansion. But price to earnings ratio is the highest it has ever been at the beginning of a new expansion. The highest it's ever been. Shiller PE, which is the inflation adjusted PE, is absurdly high, far beyond where it has ever been at the beginning of a new expansion, a new multi-year expansion. But we have all these narratives about super cycle and AI is going to render valuations meaningless and like all this stuff's happening. But we're in a delinquency cycle. We're in a bankruptcy cycle. We still have people locked into debt at yields that are less than half of what they are today. They need literally hundreds of basis points of cuts from the Federal Reserve to unlock their ability to refinance. We're not at the beginning of a new cycle, but we're having these debates. I just see a lot of parallels, and I think it's possible that big tech, which I'm using the S&P to represent here, but it could just as easily be the NASDAQ who does it. The Dow Jones could do it. It's one of those. So that's it. If you're not following me already on Twitter, please make sure you do so. I post a lot of my content over there at TXMC Trades on Twitter. Make sure you're following me here. Make sure that you subscribe to my channel, Alpha Beta Soup. We've got 19,400 subscribers. I'm trying to get to 20K, guys. Help me get there. The funny thing about this chart, I see someone mentioning it in here. I'll go back to it real quick. The funny thing about this chart is this is my metric. I designed this metric. Value days destroyed multiple. This is mine. I created this in 2021. November 9th, 2021, I published my latest experiment. I call it the value days destroyed multiple. This is my research paper that you can go find in the thread. And this is me describing how I created this metric just over 2 years ago. And so I am qualified to comment on this. And this is exactly the kind of behavior we should expect well below the all-time highs. But I just bring it up because this is only one tweet because it's the first one I could think of. But I've actually seen several other tweets that I've been replying to recently. I've been making a lot of comments about hodler activity. And the reason is because I've been seeing people saying things like, wow, I can't believe no one is spending their coins here. This is amazing. What's going on? How is this possible? How are we seeing, let me see, long-term holders since 2023, 1101. Oh, I'm trying to find the tweet for you guys real quick. Yeah. Because I see people like this Stack Hodler guy. More than 83% of the supply is held at a profit. Long-term holders refuse to sell. The Ponzi implosions massacred the weak hands. The stubborn survived and cornered the market. Now the suits approach with their fat stacks of just making stories up. No, I mean, no offense to this individual. I don't know them at all. I don't follow them or anything. But it's just it got a lot of engagement. And it's people coming up with stories. But the truth of the matter is that hodlers don't sell here. This isn't where they're supposed to sell. They sell when we actually break into new highs. But we're having these debates. Check out DXY again. All right, we'll look one last time and then we're going to get out of here. Yeah, not doing anything. Don't zoom in too much on DXY. The point is it in a macro trend? Is it breaking out? Is it about to go somewhere new? And I would argue right now, it's still in a box. Let's get up here. Let's get above this level. Let's start threatening to break highs here or down here, and then we can pay more attention. So with that, I will let you guys go. I don't feel too good about the quality of what I brought today on this stream, so I hope you found some valuable, insights, or at least was entertaining for you. I felt like some of the middle was kind of hard for me to get my thoughts out. I'll try to do better next time. I really appreciate you guys. We'll do another one of these Wednesday or Thursday of next week. And we'll just keep on rolling. Make sure you're subscribed to the channel. Make sure you have the bell icon enabled. Next time I go live, you'll find out about it in real time. And that's where we're going to leave things. So until we chat in a few days, take care of yourselves. Take care of your friends. Hope you find something enjoyable to do over the weekend. And we'll chat again in about a week's time. Cheers, everyone.